Let's go from easiest to more difficult. Let's think about a situation where we get paid by like gig work or something. In that case, the easiest thing to do would be saying, okay, I just work on YouTube or something and YouTube pays me, and I'm just going to connect YouTube or whatever the platform is to my checking account, and then I'll pull in the bank feeds. And as they come through the bank feeds, I'll have these received payments. And if this was coming from, say, whatever the platform is, it's going to be a deposit type of form, right? And then I can say that it's going to come from, I might put the customer of Google. I would record it simply to a revenue account here and then record it. And I would record an increase to the revenue account with a deposit type of form. Let's try that. Let's put it into income. Let's say sales of product. Even though I didn't have a product, I'll just put it into that revenue account just to have a demo. And then I'm not going to put any product or service, and it would be from like Google. We could say we'll put a customer of Google. I need it here, Google, and save it. And this happened on 2/6. So I'm just going to save it and then go on over to my balance sheet, run it, and check out the checking account. It happened in 2024, right? So it was, or was it in 2025? Let me go back. It was 2/6. Yeah, it isn't. That's good. So there it is right there. So notice if I go into it now, I have the deposit recorded with a deposit form. So in other words, the bank feed made a deposit type of form, even though when I did the data input, it didn't really look like a deposit. We'll talk more about bank feeds later, but let's go back up. And then the other side, we put to revenue. So let's go to the income statement, run it. And then there it is. We put it right here. Here's the 55. Now, the thing that's funny here is now we had an increase in revenue with a deposit form, which is unusual unless you're in a type of business where that's the way you're going to format it. In other words, if I go back and I look at the revenue accounts like in last year, we're not going to see any deposit forms. We're only going to see invoices and sales receipts typically. So only if you're in a type of business where you can more simplify it, like gig work or something like that, could you use basically this kind of system. And that's one of the things you want to be considering as a bookkeeper in terms of what kind of clients do you want to be picking up and how you're going to set up your accounting system based on that. Now, if you have a system where all the deposits coming through, you're just going to record as revenue, then you also have to be careful and say, what if one of these deposits wasn't revenue? Meaning, what if you, the owner, transferred money from your personal account into the checking account, or you took out a loan? In those cases, if you recorded this and this was a loan or from you as revenue, you would record revenue incorrectly because it should be going to an increase to the checking account. The other side goes to an equity account. So if you were to record it in revenue, it would be bad in the United States for income taxes in particular because it would make your net income go up, in which case you would be paying taxes on it. You'd be paying taxes on something that wasn't actually revenue. It's money that you invested into the company. So if you put money in, what would happen? We would say it's an increase to the checking account, but the other side would be going to equity. If you were the one that put money in, which you might make another account called equity, or it might come from a loan, for example, a liability from the bank. We might take a look at those transactions a little bit more later, but let's go down to the standard transaction now. Now let's think about a situation where